Hi, good afternoon, and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. My name is Amanda Sylvia, and I'm the Senior Client Service Associate for SEM. And I do want to start off our webinar with just a few housekeeping items. Please use the question and answer button at the bottom of your Zoom window to submit any questions you may have throughout the course of the webinar. I will ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and we don't get to your question, Chris or myself will reach out to you to make sure we get your questions answered. I'm really excited to introduce our speaker, Chris Gauthier, Stonehearth's Chief Investment Officer. He brings over 20 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda. Thank you for that wonderful introduction. And, thank you everyone for joining us today on another beautiful spring day in Massachusetts, he said sarcastically. So look out, dreary, cloudy day. Again, this presentation titled, Here Comes the Growth. And as we kind of go through, you see that what we're transitioning to is from a market that's really concerned about higher inflation, higher rates, to a market that's really seeing stronger and more resilient economic growth than really anybody, including myself, thought at the beginning of the year. It certainly has been an exciting beginning to the new year, and we have a lot to go through, so we'll jump right into it. At first, we'll take a look at historical returns, and as we will see, they have been very robust despite the Fed's best efforts. Then we'll kind of look at the current economic environment. We'll see a hawkish Fed, signs of stretched valuations in certain parts of the market being more than offset by really a resilient economic growth and healthy underlying price trends in investment markets. Then lastly, we'll take a look at how all that data and the weight of the evidence is translated into a portfolio for our clients. So with that, let's start historical performance. We'll start off with Q1 2024 performance. So since the last time we spoke, it's really been a very strong start to the year for risk assets. As fixed income continues to trail a little bit. So what we're looking at here is multiple asset classes. And as always, we have U.S. equities in blue. So anytime you see that light blue, think U.S. equities. You can see the S&P 500, very robust, almost 10.5% return in the quarter. NASDAQ, a little bit behind, but 8.5%, followed by U.S. small. In green, we have international. That's anything overseas, think emerging markets, developed markets. And while not keeping up with the U.S., still had very strong returns. Frontier markets up almost 9%. International, above 5%. And even emerging markets, which have been trailing for the majority of the time period here, still managed to poke its head above positive and generate a positive return in the quarter. But really the story in the quarter was those yellow bars. And the yellow bars are really anything that doesn't fit into that equity or fixed income bucket. You can see on the left-hand side, commodities really were the winner in the quarter, up almost 20%, followed by oil, which is a big piece of that commodities complex, up 18%. Really driven by two things, right? Stronger economic growth. When we have economic growth in this country, we pull on those commodities. We demand more commodities. And when we see that demand increase, we see price rise. And we definitely saw that in the quarter. Also, a little bit of a geopolitical risk in there. We all know that there's a couple wars going on over in Europe and the Middle East, and that does have an effect on those oil prices. So when we look at in terms of what didn't work in the quarter, there's really not a lot. It really is those long-term treasuries, which is over here on the right, down 4%. And that's to be expected, as we'll see throughout the presentation, stronger economic growth. We see rates rising. When rates rise, bond prices tend to fall, right? So, yields up, bond prices down, and you see that reflected in the return of long-term treasuries. But even having said that, there are some pockets of positive returns in fixed income. If you are willing to take on some credit risk in like the high yield market, you get 1.5%. Take on some floating rate risk, you can generate some 2% returns. But overall, looking at the total picture, definitely was a very good time to be invested in the equity markets and risk assets across the board. So let's dive into a little bit more details, really looking at that S&P 500 and really what made up that 10.5% return. And what we're looking at here is the top and bottom contributors in the quarter to the S&P 500. We look on the left-hand side, those are the positive contributors, and we're seeing those names again, those MAG 7. could be now the Fab 4 or 5 when we look at the data, and we see that the best performing stock in the S&P 500 index in the quarter, no surprise, we know and love it, NVIDIA, up almost 82%, which is almost unreal. But the big takeaway is being up so much, it contributed 2.5% to that 10% return. And then we look down the bottom and we see those top 5 contributors, NVIDIA, Microsoft, Meta, Amazon, part of that Mag 7, you see that half the return of the S&P was really driven by just those 5 names. So even though we did see some broadening in the quarter, we saw some other names kind of join the party, Disney, GE, MasterCard, it still is a very highly concentrated market. So we did see improvement, but concentration risk is still looming over the marketplace. When we kind of look at what didn't work, there really wasn't a theme, but we did see, like we mentioned, the Mag 7 kind of becoming the Fab 4 or 5, and we saw that Apple, right, was a big piece of that Mag 7 for a long time, did not really have a good quarter, down almost 11%. Tesla, another investor fave, down 30% in the quarter, really based on just decreasing demand for their cars up there and trying to open up new markets in China. You saw that was 50 basis points contribution to the negative return. So overall, the takeaway is Mag 7 still working, still having up decent performance, but still having that concentration risk, given that it's so concentrated in those top 5, top 10 names. But on the brighter side of Q1, a very robust Q1 is usually a good omen of how the rest of the year will play out. And what we're looking at here is that data from our friends at Danvers, going back to 1930. There have been 15 instances when the S&P has been up over 10% in Q1. You can see those listed here and listed the returns over here. But more important for portfolios and for our clients is, what does that say about what's going to happen for the rest of the year? And that's this column right here. And it's looking pretty good, right? So out of those 15 instances, we've only seen 2 that had negative returns for the rest of the year. 1930 during the Great Depression, and 1987 we had Black Monday. So overall, looking at a very robust, greater than 10% return in Q1 usually leads to further price appreciation, median return of 7.5% for the rest of the year. Nowhere near what we saw in Q1, but still a very decent return and nothing to sneeze at. So strong Q1 bodes very well for the rest of the year, providing support for tilting into risk assets. So taking a longer time frame, looking at those same asset classes, so anything in blue, still U.S. equities, anything in green, international equities, anything in purple, fixed income bond market, and yellow is anything that doesn't fit in. Although the makeup of the leadership may be a little bit different, like we saw in the quarter, we saw commodities lead the way. Over the trailing 12 months, we see NASDAQ still clearing away the big winner, up 39%, followed by the S&P at 30%. The overall story still remains the same, right? Risk over safety, equity over fixed income, and U.S. over international. Doesn't mean you didn't have decent returns outside of the U.S. You're still looking at international equities up 15%, still decent to be in there. If you wanted to take some high yield credit risk, you're up 9%, very good, strong returns. And like we saw in the quarter, long-term treasuries, again, given the Fed rate hikes, what we're seeing with rates, no surprise here that it's lagging over the past 12 months, down almost 8%. The other losers over the past year, thematic. When we look at thematic, those are those small cap, high growth, no profit companies that need to borrow to fund growth, which you would expect to trail in a rising rate environment. And we also see commodities posting a negative return. Now, oil's up 18.5%, and it's a big piece of the commodities, but what's really driving that negative return in commodities is natural gas and that unique circumstances to that marketplace, which is also the second biggest piece of that commodities ETF. And really driven by the US's decision not to export any more natural gas. So if you think about it this way, if we're not exporting natural gas, it has to go someplace, which means it stays in the US. When we have an overabundance of something in the US, like a natural gas that used to go overseas, in the US market, prices tend to come down. So that market's oversupplied. So that's where you see that negative commodities market. So again, but overall, it's still very strong performance over the past year. US was the best, but overall, there really was a lot to like in all the asset classes over the past trailing 12 months. So that's kind of where we've been. Now we kind of really want to look at where we are now and what that portends for the future, right? Where are we going? What does the data and the weight of the evidence indicate for how the rest of 2024 is going to play out. And the first data point we're going to look at is U.S. monetary expectations. And this is just the Fed funds rates, right? And there's a big difference than when we met last quarter, and really has to do with the market coming to realization that the Fed is going to lower rates and not as fast as they fully expected at the beginning of the year. And that can be seen over here in the chart. So this is made up of two different market participants. You got the Fed in the blue, so think about the dot plots, what the Fed says they're going to do with rates. And then the green line, which is really overlapping with that blue line right now, what the market thinks. So if we go back to the beginning of the year, the market was really pricing in 6 cuts. Now, the Fed was never up there. They were at 3 or 4 cuts, but there was that gap there. And that's a risk, right? That's a risk to the marketplace. When investors don't agree with what the Fed says they're going to do, that increases the risk that we could have a dislocation in the marketplace if they don't get what's expected. And the way to look at it is, with the market moving to the Fed, how come we didn't have a dislocation? It's really the speed of that, right? The market didn't come around and say, oh my God, the Fed's not going to cut as much and slam the door shut. They kind of just slowly closed the door and came around to that realization, which led to higher prices in the equity market. So again, looking at the marketplace, still looking for Fed rate cuts based on the Fed expectations. We tend not to agree with the Fed. It's tough to see how we're going to get any rate cuts this year. Doesn't mean the Fed doesn't, but when we look at the data, we want to take them on their face. And what they say is that we look at the data to drive our rate expectations and our rate decisions. The data is really not supporting lower rates from here. So again, reduction coming into the year, 6 rate cuts down to about 1 or 2. But in terms of what we think at Stonehearth, more likely 0 to maybe 1 on the outset. And why do we think that? It's the data, right? So let's look at the dual mandate of the Fed. As we all know, it's inflation, stable prices. That's in their mandate to get inflation down to 2. And as we talked about consistently in these presentations, that last mile, right? That last little bit of inflation is going to be the hardest to get down, and it's just not cracking. So looking at 3 different ways to look at inflation. The first one is the CPI, Consumer Price Index. That's the headline number that gets reported. That's all prices paid by consumers. And you can see that definitely since 2022 at the peak, we've made a lot of progress, right? Almost down to 2023. When we kind of look to 2024 and what's happening, we see something shifting, right? We don't see it coming down anymore. We actually don't even see it stabilizing. It's actually starting to rise a little bit. And then when we look at the Fed's preferred measure, right, they like core, that's this middle box right here, is that just strips out food and energy. And we've talked ad nauseum about, I don't know why the Fed does that, because everybody has to eat, everybody has to fill up their cars. And that's telling a similar story to the headline CPI. Great progress from the peak in 2022, leveling off to kind of increasing here at 3.8, which is a long way from the Fed's mandate of 2. And lastly, taking a look at the path of inflation from the producer price index. Think about this as the beginning of the production process. What are we paying for our raw materials? What are companies paying at the start of the process? And if you think about, if you pay higher prices at the beginning of the process, that should translate into higher prices at the end when it gets to the end consumer. And just like the other 2 data points, we saw some tremendous amount of progress since 2022, but it's headed in the wrong direction right now. It's up a little over 2%. So looking at half of the Fed's mandate, it's really tough to find any support for cutting rates unless we see major improvement on inflation. And it's actually not improving, it's heading in the wrong direction, at least in 2024. So that's one piece of it. The other piece is the employment market, right? And the other mandate they have is full employment. And on that end, it's looking pretty good, right? We're seeing very low unemployment. It's at 3.9, and that's pretty much full employment. Due to some friction in the marketplace, it's a little bit above what we consider full employment at 3, but still very strong labor market. And even more important to us, we're seeing strong wage growth in this market. That's this blue line. And you can see that the 50-year average of wage growth is 3.9% from this call out. We look at what we are at this chart. This is as of February 2024, which is the last data point we have. We have a wage growth of 4.5%, which is very strong. Also, when you take that into account within the inflation number at 3.8, you actually see real wage growth for consumers, which means they have more money to spend. When consumers have more money to spend, we all know what consumers do. They spend. If you spend, increases demand, increases prices, and you can see where the self-fulfilling cycle keeps coming in to raise inflation. So looking at the two really main pillars of what the Fed does, or what their mandates are: inflation not coming down, still higher than expected, a strong labor market with decent wage growth, does not really provide support for any Fed rate cut. So again, taking the Fed at their face, saying that they only follow the data is pointing to higher for longer for interest rates. Another leg of support for higher for longer is financial conditions, which, despite the record speed and level of hikes by the Fed, are still easy. And again, we turn to our friends again at Danvers to kind of provide some data, and they have put together this NDR Financial Stimulus Index. And what we really want to concentrate on this red line. And what this is taking into account stock prices, the credit markets, the money sloshing around the system. Is that supportive of growth or support of no growth? And we can see throughout time it fluctuates, and you can see that it has in the no growth area. And you can see what we want to call out here is what's happening since the Fed started raising rates, right? You can see it's been definitely decreasing, right? Less supportive of growth. But we see this change here, right? It bottomed out, didn't even get to no growth, right? So they're still, despite the rate hikes, they're still in moderate growth level and heading towards growth. So when we look at the financial conditions that are out there in the marketplace, like how much money is sloshing around, it's still providing support for future economic growth, which should keep inflation higher, should keep people employed, and provide support for equity prices and risk assets as we move out in 2024. Now, the good question is, what's causing this, right? The Fed's raising rates, they're doing their damnedest to, slow economic growth. It's just not happening. And we can see from financial conditions index. And to us, really the main driver is the current fiscal policies of the federal government, which you would think have the same interest and goals as the Fed, but they clearly don't. When we look at this next chart over here, this is just basically the federal deficit going back to 2016. And you can see the government's reaction to the COVID crisis. They threw a whole lot of money at the wall, hoping something stick, and it worked. 2021, still fighting the crisis, up, have a deficit of 2.5%, still good. But what to us, and surprising to a lot of people out there, I would bet, is that we're still not back to normal levels, right? 2022, we're still spending a lot more than we're taking in by the federal government, providing stimulus for the economy. And then 2023, it actually increased. Think about the CHIPS Act, stimulus for creating semiconductor manufacturing in the US. Inflation Reduction Act, which has nothing to do with reducing inflation, just throwing money, and the Infrastructure Act, again, throwing stimulus at the economy, providing the fuel for growth. And even when we look out for estimates for 2024, while it's decreasing a little bit, it's still providing a whole bunch of stimulus to this economy. And the way to think about this is when you think about what the government does, the government takes taxes, that takes money away from the economy, away from growth, right? It's not in the economy, it's not being put to use in the economy. But by throwing money back into the economy, providing stimulus, spending more than they're taking in, they're putting money back into the US economy, which is, again, depending on your point of view, it may be good, especially in the short term, but there could be long-term consequences, which can be seen in the Fed's government finances. And, I would look away if you have a heart condition or squeamish, because it's not a pretty picture. I'm looking at the federal government's balance sheet for 2024. On the left-hand side, you can see total spending up at 6.5 trillion and the makeup of that. Then you look at the financing, what they take in for taxes and things like that. And you can see this big white call out here that they are spending a lot more than they're taking in, almost 1.5 billion, 24%. So the way to look at this is, and we talk about, putting money in and out of the economy, for every $100 the government is taking out of the economy, it's putting back in 125. That is going to stimulate growth. That's going to have an impact on inflation. And you can see offsetting a lot of what the Fed's doing in terms of trying to slow down economic growth. So the government is really offsetting a lot of what the Fed's trying to do. And the big call out here is this federal net debt, this bottom right-hand chart. So again, we talked about long-term consequences. This is the federal net debt percent of GDP. And you can see it's onward and upward, straight to the right, currently at 99%, which is up there, but no signs of slowing down, right? So this is from the CBO. They have no skin in the game. They're not a political party. They're just a government office based on current policies in the federal government. We see no signs of slowing spending in the economy, which does provide support for growth going forward. And we're seeing this, right? We're seeing this in the economic data. We're seeing this resilient economy as growth expectations rose in the quarter as we look at through the PMI lens. And what these PMI measure is economic activity. They do services, which is the red line, and the green line, which is the manufacturing, the industrial base. And you can see during the quarter in 2024, it's higher than it was, right? So this is the economy coming around that we expect stronger growth. Anything above 50 is in expansion mode. And we can see that manufacturing just popped its head above 50. And even though services are slowing a little bit, it's still higher than it was to start the year. And the reason we look at this a lot to measure economic activity, because it has a lot to do with what's going to happen in the economy, not to what happened. We look at a lot of the economic data the government provides. We look at GDP. That tells you a great picture of what happened. These surveys are really looking at what's going to happen. They're diffusion indices. They're calling up companies and asking, are conditions getting better, staying the same, getting worse? And if the majority of the conditions are getting better, you get above 50 reading. And you can see that it's definitely firmly above 50, which portends to future economic growth. And this is just looking at it from the US standpoint. When we look at the global economy, it's also in expansion mode, right? This is just not a US phenomenon. You always hear the US is the best house in the economy, but other economies are growing as well. This, we're looking at the same PMI numbers done by a different company, still breaking out into manufacturing and services, still using the same colors. And if you look at these heat maps, the way to look at it is when you see red, we're in contraction. When you see green, we're in expansion mode. You look at the right-hand side about the current conditions, really tough to find in contraction. The total economy, is at 51. Look at developed markets, 51. Emerging markets, 53, firmly above. And there are some pockets of weakness, mostly in Europe, Germany, France. But again, taking and hold as a whole and the weight of the evidence, you see in a global economy that is expanding tremendously out there. So again, a lot of economic growth. And I think that's the biggest difference is why we titled this presentation, Here Comes to Growth. So we didn't see this in 2023. It wasn't so robust. I mean, we're really seeing this in 2024. The market's attention shift from the inflation to the impact this growth is going to have on risk assets. And you saw that in the price movement in the quarter. And hopefully, as we look out into 2024, you see it keep increasing prices as the data indicates. So before we turn away from the economy, you're also missing a big piece in all this data, right? The consumer. They make up 70% of GDP. And we want to take a look at it from multiple lenses. And the first one we're looking at the top is a 30-year mortgage rate. So you can see the Fed has done some work, right? It was record lows at 3% or thereabouts, all the way up to 7%. And we get a lot of questions that, this is going to kill economic activity. No one's going to buy houses at 7%. There's a lot, the mortgage rates are just too high. It is for certain circumstances, and I would hate to be someone trying to start a family or try to buy a house right now. But when looking at the economy as a whole, we look at cohorts. So let's look at and think about the people that are greater than 55 years old in this market right now. They hold about 75% of the total wealth in the US. And you think about their life circumstances, they're probably not in the home buyer's market. And especially if they were client of Stonehearth, they more than likely took out their mortgage or at least refinanced when it was down 3%. So if you think about it that way, this could go to 10, 20, 30. You still have 75% of the wealth who's probably still at 3% and does not really impacted by what mortgage rates do. So again, negative for a new home buyer, but still not high enough to dampen economic activity because everybody has a house at 3% who controls the wealth. The next chart down is gas prices. I always put this one out there. It's a good indicator of what's going on. We have to fill up our tanks all the time. I know it affects my economic outlook. I just filled up the other day. It was at $3.50, I think. And I'm like, wow, that's really high. It does impact my my spending. And you can see that it is really high. But when we take it in conjunction with what the consumers are doing, it's not impacting yet because they're still spending, right? And that's this purple line right here, retail sales. growing year over year. And we can see it's a very robust 3.6%. So consumers are still out there spending. They're looking at it. And the big question comes now is why, right? What's supporting the spending? Well, we saw the low unemployment rate, right? We saw wage growth. That helps. But to us, we look at this next chart is the index of consumer sentiment. It's kind of how consumers feel. And we can see from the data, they're feeling better. They're almost back at the long-term average. They're confident. And you can think about your own personal circumstances, right? When you feel confident that on your income level, you feel confident that your job's going to be there next year, you tend to spend more, right? The better you feel, the more you spend. So that is supporting that retail sales to keep growing because consumers feel good about the future. And to us at Stonehearth, the most important chart is the bottom one in green. And it's the household debt service as percent of disposable income. Just a long way of saying is how much of consumers' cash flow on a monthly basis is going toward paying down debt. And we can see that it's below average at 9.8%. So you can think about this as capacity, right? We know US consumers love to spend. And they will spend up to their limit. And that's what this is measuring, right? Do they have the capacity to spend? Do they have the capacity to take on more debt? This is not asking, should they? Because if you're a client of Stonehearth, we know that we never want to spend up to our capacity, but not everybody in the US is a client of Stonehearth. And we know from history that consumers will, in the whole, spend up to their capacity. And what this data is telling us is they have some time before they get into trouble, right? They get into trouble when it's 12%, 11% of their disposable income, and we're just not there yet. So the big takeaway for the consumer, despite some of the data points you see, despite some of the news reports you see, they're still in a great position to spend, which they are. Can you see from the retail sales growing? They feel good about themselves. They have strong confidence from their sentiment numbers, so they're willing to spend, and they have the capacity to spend. So putting it all together, looking at the weight of the evidence, like we always do with all this data, it really supports a consumer that is going to spend as 2024 rolls on, which should provide support for economic growth. Economic growth provides support for earnings. Earnings provide support for equity price appreciation. So again, the equity market has a good base here based on consumer spending. So that's really the economy. And, the big takeaway is growth is coming in hotter than expected. It's here for longer. It's proven very resilient, and which bodes well for the rest of 2024. So that's the economy. So now let's turn to the equity markets. And we'll start with the S&P 500. And as we always do, we'll look at valuation as the biggest driver of long-term returns. I'm looking at the PE, right? And this is the price to earnings ratio. And all this is measuring, going out through history back to 1994, and this is given the earnings level, for $1 of earnings, what I'm paying for. So we look at that last number here, 20.96, the last reading. What this is telling us is that I'm willing to pay, or investors are willing to pay, 21 times $1 of earnings. And we can see throughout history, it fluctuates, but we start getting nervous when we get to those extreme levels. And we kind of define those extreme levels as one standard deviation. And you can see that it's definitely going through there, right? It definitely broke through there. Doesn't mean it has to come down right away, but you're starting to get those levels that are very concerning in the marketplace. So again, I have no doubt when we look around all our assets, it's S&P 500 is overvalued based on the headline number. And we can see that in other valuation numbers too. So we look at the CAPE, which is just a PE ratio looking over a 10-year horizon rather than a 1-year horizon and taking into account inflation, that's overvalued. Dividend yield, almost at record lows. So that pretends a market that's overvalued. Price to book, and price to book is just the price you're willing to pay for all the combined assets of the fixed assets of the S&P 500. That's showing an overvalued market. Price to cash flow, how much am I paying for the cash flow generation capabilities of the equity market? Still overpaying, 16 times compared to a historical average of 11 times. Earnings yield spread is showing a little bit undervalued, really based because of the low rates, because we started off with a low base. But overall, when we look at the S&P 500, valuation is definitely extended. Now, the flip side to valuation is momentum, right? When we look at the equity market, that it has poor valuation, but when we look at the momentum, the technical backdrop, it's still fairly strong. So looking at the S&P 500 still here on a weekly closing basis. Look at the top chart right here. That's the RSI. Think of that as a sentiment indicator. Again, Is the market getting a little frothy? Are we getting a little too excited? And we can see that definitely in March, we got very excited above that 70. That's the line in the sand that says, okay, we're getting a little bit too ahead of ourselves. And we can see that in April, at least, it's corrected a little bit, right? It's come down below. Not to levels that are really exciting down with 30, but again, it alleviated some of that negative sentiment. So even though it's not the perfect conditions, it's not at extreme levels. The bottom shot here, the MACD, is showing the same exact thing, trying to measure sentiment in the marketplace, and it's never good when that black line crosses the red line. So you can see, again, pointing to the same thing, getting a little bit ahead of ourselves. But what's offsetting that and more is the other technical backdrop, and that's this middle chart that I want to focus on. It's really important. So what we're looking at here is the S&P 500 on a weekly closing basis. That's this black and red line right here. But look at the moving averages. So we have a 50-week moving average in blue. We have a 200-week moving average in red, both heading upwards and to the right. That's good, right? That's providing support for equity prices. That's when you hear a positive trend or an upward trajectory market. That's what this is indicating. And as long as those are heading upward and to the right, that's providing support for equity prices. And the line I added here myself is this support and resistance. That's this big red line here. And this just indicating key points in the market. And we can see that from this line, 4,600 seems to be a pretty key point. And we see that here, right? So back in 2022, it bumped up to that line, came back down. In 2023, it tried to break through again, just couldn't. And we see some weakness until the end of 2023 when it went through. So when we see that red turn to green, it means resistance is turning to support. So what we're looking at is, and we're seeing the kind of pullback in April, is that any pullback we've seen should be shallow and short term if it can kind of hold this support. So even though we see a little bit of rollover here, we're not too concerned, although we never like to see the market go down. It's not that long-term wealth detriment on the longer term. It's more of a shallow, normal, everyday volatility, not those crises we're trying to avoid here. So again, technical picture, very strong from the S&P 500 side. So we get a much rosier picture when we look at the technical side. But it's good to note that the S&P is not the only game in town. It gets the most press. Everybody talks about it. But if you're willing to move away from the headline index, you can potentially find some better risk-reward opportunities in the marketplace. There are a lot of other equity assets to invest in. And that's what this chart's showing. Still looking at valuation, still looking at the same things we saw before, PE, price to book, price to sales. And what we're looking at here is for different parts of the markets. Because the S&P 500, like we saw in the previous charts, definitely overvalued, but willing to move down in market cap space in the 600, the small cap indices, you can see it has a good valuation support. It's not as overvalued, and it's even trading cheaply compared to the S&P 500. Going over to the international in Europe, you want to tilt into those, you can see they're not in the same overvalued market as like the S&P 500, and even some really inexpensive assets in China and Brazil. And again, the flip side of valuation is momentum. And what we're really looking for is, that fat pitch. You always hear about people talk about that fat pitch. And to us, that fat pitch is when you have valuation support and momentum support. It doesn't happen that often. It does happen. And when it does, you really want to take advantage of it. But you're really trying to find that best balance between valuation and momentum. And when you're looking at momentum on the flip side, right away, looking at those colors, you can see where you're finding that better balance, right? There's better balance in the small cap space. There's better balance in Europe. So you want to be tilting into those assets. Again, not finding that fat pitch not yet, but we could at some point, but looking for that best balance. So look at the S&P 500, still has positive price momentum, but again, the overvalued picture. And then we do get a lot of questions on China. So I just want to kind of call this out because we saw that cheapness of China, and it's really been struggling really over the past 2 years. And they said, well, what will it take to get us excited about China? Well, for us, it's price, right? You can see down here, China, it's still at very negative price momentum. So what we'd like to see is that kind of start turning green, and that would get you really excited about maybe getting into the China market. But it's just not there right now, right? It's just still uninvestable given where we are from a momentum standpoint. So the big takeaway, looking at the equity markets, that yes, the headline indice S&P 500 is definitely overvalued, but if you're willing to move away from that headline indice, there's much better risk reward potential out there in other pieces of the equity market like small cap and international, and you want to have portfolios be tilting into those to take advantage of that situation. So that's kind of where we stand from the equity market. And I'm going to take a look at the fixed income market, and we'll start with the yield curve. And all the yield curve is use the U.S. Treasury yield curve here, looking at the U.S. government's fixed income borrowings. And all it says that 1 month, short term, the market's willing to lend to the government at 5.4. On a 2-year horizon, they're willing to lend to the government at 4.6. Going out many years, 30 years, they're willing to lend to the government 4.3. So we saw the movement in the curve was all in the long end in the quarter. So again, when we met last, 12/31/2023, you can see really no change at the short end. We've seen all the change at the long end. And this makes sense, right? Because the Fed doesn't control the long end. They move this, right? They control this. They have an impact on this, but they don't directly control it. And that's that market moving to the Fed's point of view, right? We looked at that in that first chart, that monetary conditions. We see the market moving to the Fed higher for longer, and that's being reflected in this fixed income yield curve, which we call steepening, right? And that's when long ends move higher than short end, and you can see that tilt in the yield curve. It's called a steepener, which is really capturing that same narrative and telling the same story as the equity market. It points to stronger growth ahead, right? Unfortunately, this doesn't help current fixed income returns like we saw in the long-term treasuries, right? Because we know price moves opposite of yield. But there is some good when rates rise, right? Because what it does is it increases the income available to investors from the fixed income market and puts them in a better position. And that's what we're looking at here. So when we look at this, we're looking at multiple different fixed income asset classes. We'll concentrate on the US Treasuries here, because that's what everybody really knows. And you can see we're looking back over 10 years, the market has had income between 5% and almost down to 0, but has averaged about 1.8%. So again, taking a lot of fixed income risk when I'm only getting 1.8% coupon, it's not really a good situation for me, right? It's not what we call a good investment. Doesn't mean it's just not good, right? Because you're not being compensated for that interest rate risk. But as we can see with the current yield, which is these diamonds here at 4.4%, that's not the case anymore, right? That's the big difference. This is why fixed income may be investable now compared to a year, 2 years ago. It's because you have a much higher starting income point. And what that does is it gives you the ability and pays you to offset some of the interest rate risk. So again, even if rates rise from here, prices go down a little bit, you have more of a buffer because you're getting a higher income stream. And if you're willing to move away from US Treasuries and take on some excess credit risk, you can even get higher yields. Look at the mortgage market, right? You can get up almost 5% compared to 3% a couple of years ago. You look at the high yield market, right? It's up at 7%. So the takeaway from the fixed income market is that yes, rates are going to stay higher for longer. Yes, higher rates could hurt bond prices, but now that the income level is that much higher than it has been over the past 10 years, you're being compensated for that risk and leaning into some duration exposure, adding some fixed income is not the worst thing in the world, given you have this very high income level compared to what we've seen in the past. It's kind of the strategy we call sit and clip, right? Sit in the fixed income instruments, collect that juicy, nice coupon, and that should offset the risk you're taking in rising rates. So before we leave the fixed income market, we want to look at credit stress, and we're looking at that in the form of yield spreads. And what all yield spreads is what banks charge over and above the treasury, right? We know the treasury is the risk-free yield rate. You lend to the government risk-free, is what banks are willing, or private credit companies are willing to lend to companies above that, right? How much are they charging? How risky do they see lending money to the corporations compared to the government? When that spread is wide, they see a lot of risk, right? There's something in the marketplace that scares them. When it's tight, that they're seeing a resilient economy, that they're confident they can get their money back, and they're asking for a less premium over the treasuries. You can see through time, back to 2004, it's kind of fluctuated. And you can see that there are clues, right? When financial stress comes, like we saw in 2008, during COVID, you see these rates rise. Normal market movement, expectations. If the outlook is dire or, not as positive as it is right now, you want higher rates when you lend to the companies. We're just not seeing that. And actually it's going down, it's collapsing. You can see it going down here. And really from the quarter to date numbers, you can see just how much they've come down. So again, what does this say about the fixed income market? It says that they're seeing no signs of stress. A good company can borrow money at very decent rates. So again, we look at economic growth. What does pretend for risk assets? It's providing support. Now, it's not all rosy, right? Because when we look at that spread, as it lowers, I'm getting compensated less. Just like when income rises, I'm getting compensated more. When income gets lower, I'm being compensated less. So taking on that excess credit risk may not be as good as it was last year. So again, moving out to duration, taking on some interest rate risk seems prudent given where we are in terms of the level of interest rates and the spreads we're seeing in the corporate credit market. And then the big takeaway for the economy, no signs of stress from the bond market. And throughout history, we've usually seen the bond market usually gets there first before the equity market. So this is what we'd be looking for clues. If the economy starts to turn, we'd start to see these spreads widen, and we're just not seeing it. So before we turn to your questions, to see if anyone has any questions out there, we're going to go through key takeaways, right? So what did we learn in this presentation today? I'm sorry. I'm going to stop for a minute and go through the risk models. So I apologize for that. I was jumping ahead on that. So the first thing we would look at is a Ned Davis risk models. So when we look at the economy, we look at the equity markets, we look at the valuation pictures, how do we put that all together into something we can use and inform our portfolio decisions, right? We put together those in risk models. And the first risk model we use is the Ned Davis Research Fab 5. Again, this is from our friends at Ned Davis. They have history going back to 1981 on this. And this is just synthesizing all that data we looked at and kind of boiling it down to what matters in terms of price appreciation in the equity market. And it breaks it down to 4 subheadings. Tape, right? That's trend, that's momentum. We saw that's very positive, right? We saw upward sloping moving averages, market that's above support. So again, very strong. Sentiment, we saw in the data, getting a little bit frothy. People got a little bit too over their skis a little bit. We're seeing that bearish indication on that. Monetary, those are those financial conditions, the government spending money. There's a lot of money sloshing around the economy, which supports growth. And that combo, which is looking at all different financial asset classes, are they in positive trends? Are a lot of the individual names in the indice making new highs? And all that is bullish. So again, we put that all together, we come up with a score of 3 over here, which leans bullish. So what does that mean? Well, looking at the history, you go back that when this model is above 1.5, like it is now, you've generated, on average, a 27% return. So that's good. So it's good, pretends good 2024. When it's in that neutral range, that negative 1.5 to 1.5, we still generate some positive returns, but much more muted at 8.5. And what we're looking to avoid is that below 1.5, right? And you get those really negative returns. So putting that all together, you see that it's really supporting for risk assets and that gives us confidence to tilt into the equity market here. Now, when looking at the NDR Fab 5, we didn't think it was a complete model. We thought it was missing a few pieces. It doesn't have a lot of valuation in there. So what we did is we built our own internal complementary model to that to capture those pieces that we think Ned Davis is missing a little bit in their model. And just like the Ned Davis model, not very exciting, not a lot of changes, but we did make some progress. So the last time we met, for December, we had a -1 as a score, which is negative for risk assets. And we see the change in the quarter up to +1. What really drove that was a couple things. We did see some weakness in individual indicators, like we saw in the sentiment, the RSI, you can see that went from neutral to negative, so that brought the score down a little bit. We also saw copper, which we say has a PhD in economics. And that really, because the driving the industrial process, when these people expect future economic growth, they want to buy raw materials, they go to look at copper, they buy copper, increased demand, which increases the prices. So when we see copper prices rising, that's really a positive for economic growth looking out. We saw a little bit of dip in copper, not really a fall off, more of a flatlining, so we moved that to neutral. But what really drove the upward move in our model is valuation, which seems kind of counterintuitive after everything we talked about being overvalued. But we got to remember, when we look at valuation in a just very simple form, we use the price earnings ratio, right? Remember, price over earnings. For that to come down to a more attractive level, there's 2 ways for that to happen, right? Price can come down. That's the bad way, because we don't want to see negative returns in the marketplace. Or the denominator, earnings, could rise. And that's what we're seeing in the marketplace. That's why that kind of jumped from a negative to a neutral. We're seeing very good, strong earnings growth from companies. And even as Q1 2024 just started, more companies are beating earnings than missing. So you're seeing earnings grow, and that's one way to alleviate that overvalued picture. And the last piece of our model that really moved was this qualitative piece. It went from negative to neutral. And we think about qualitative, you can think about on the right-hand side, describing our individual indicators, factors, right? They just don't, they're not captured and can't be captured in a quantitative model. So we use judgment frames on a quantitative framework. And what really drove that upgrade was the market moving to the Fed's point of view, right? So again, we always talked about in the beginning of the presentation where there's a risk, if that gap is there, if the investors in the marketplace think something different than the Fed, there's a risk to a dislocation in the market. Now that they're on the same path and in agreement with what's going to happen, that risk is removed, which indicates that we should be moving a qualitative indicator up to neutral. So putting it all together, that comes to a +1, very strong technical backdrop, still a little bit overvalued, but at least a little bit less on the improvement in earnings, a very positive macroeconomic backdrop with no negatives from qualitative, gives us a positive outlook in terms of where we should be from a risk modeling perspective. So both models are in agreement that it's all right to be leaning into risk here. So now that we know the data, we know what the models are indicating, how does that translate into a portfolio, right? How does this data get into our portfolio structure? Well, we put together our asset allocation on Stonehearth Capital's moderate portfolio. We run multiple portfolios here at Stonehearth, but we're using our moderate. You can think about this as a traditional 60-40 or balanced portfolio, and compared it to the benchmark as of March 31st, 2024. And you can see right away that, we're overweight equities. And why? Saw the trend as positive, right? We saw the firming economic growth and inflation outlook, which should continue to drive earnings higher, despite the valuation concerns. You want to tilt into that and be overweight equities. And the makeup of that equity allocation, you can see US, we're neutral. Why? Well, that neutral is really driven by that headline S&P 500 indice, which is in a tremendously overvalued position. So we want to be a little light in there. But again, as we saw, there's pockets of valuation support in small cap and international that you can kind of tilt into, which is why we're overweight international developed markets, right? Much better valuation picture, still in a positive trend market. So that gives you support for being overweight. And emerging markets is neutral, really driven by that China. And we talked about that. We really need to see that price momentum move at least to neutral before you get anywhere excited about investing in China again. In terms of the fixed income market, we're neutral. Market weight bonds, as we saw, yields remain attractive, but could see increased vol as central banks really continue to shift policy. Credit fundamentals are strong, but spreads are tight. Taking a little bit more duration risk is not out of the question here, given the extra income you can get, given the rise in rates we've seen over the past 2 years. But it pertains to a market weight allocation to fixed income. Opportunistic is overweight and really made up of 2 different pieces. So the first piece of that is we have an allocation to gold. Again, we think gold is a really nice hedge in terms of inflation risk that the federal government does something, and geopolitical risk. And you really saw that play out in Q1. We saw some very nice returns from gold in that thing. And the other piece of that is our relative strength strategy. So we run internal relative strength models. And all that means is we're looking for pieces of asset classes that are outperforming other asset classes and are showing strong price trends. And what we're really seeing, which comes as no surprise, given we just went through the presentation, large cap equities, right? Even international equities, US equities are showing that strong price trend. So it gives us confidence to tilt into that asset class, which is why we're overweight opportunistic. And lastly, cash, we're underweight. I know cash is yielding about 5%. There, give or takes right about now, and given what we've experienced for the past 3, 5, 7 years, it seems like a great return, and it is. And cash is still a big piece of client portfolios. But what you have to understand is it does open yourself up to reinvestment risk. And what does that mean? When we think about cash, we got to think it's a floating rate instrument, right? That income doesn't stay the same. If the Fed starts lowering rates, that cash rate's going to come down with the Fed. If the Fed starts raising rates, it's going to go up too. But again, focus on reinvestment risk. If the Fed starts lowering rates, which they will at some point, we don't see it happening anytime soon, but at some point they will, you're going to want to be out of cash. Then you're going to want to buy a fixed income instrument to get that income. But as the Fed's lowering rates, we saw how rates happen in the fixed income market, those will come down too. So while it's great to earn 5% now, there's no guarantee 1 year from now, you're still going to be earning 5%, which is really why we want to be underweight cash on an overall basis. So with that, now we'll turn to the key takeaways. I apologize for that. So now we'll turn to the key takeaways to see what we've learned today. First thing, monetary policy. We saw the gap closed between investors and the Fed, which is good for markets, and remove that one major risk out there that because they don't agree. And despite the record 525 basis points of hikes, the Fed is not hurting the economy yet, right? Financial conditions are still easy on the back of continued government spending, which is supporting that growth in inflation, which is an antithesis of what the Fed's trying to do and trying to reduce growth in inflation. But for now, the government's winning on that. So expect a higher for longer interest rate regime, really due to three things, right? We really want to watch three things. We talked about inflation, right? If you look at the data, when the data driven is what they say, inflation is still too high, still needs to come down more. So they can't put the mission accomplished banner up yet. So no need to lower rates. Employment, as long as we get strong wage growth, we're at full employment. There's really no reason for the Fed to intervene into that marketplace by lowering rates to support it. So again, providing support for higher for longer. And lastly, bond liquidity. And this is like the 2008 experience, is this when bond markets freeze up, when good companies can't borrow money, when the pipes behind the scenes kind of freeze, that's when the Fed could step in and lower rates tremendously to kind of solve that problem. Not seeing any signs of that. We saw that in the yield spreads, no financial stress in the marketplace. Financial conditions are still easy, so that provides support for higher for longer too. But that's one thing would change the Fed's thinking. We saw in the economy, consumers hanging tough, has the capacity and willingness to spend. And we saw the market, right? It's really turning its attention from all the problems with inflation to really what that means from the growth perspective, right? Inflation is all right if you have growth accompanying it. And the market likes what it sees, and we do as well. High valuations, still a cause for long-term concern, but there are pockets of opportunity if you know where to look to kind of move away. Sentiment got a little bit ahead of itself. The market has definitely come a long way in a short amount of time. May need a little breather, which we're seeing in April. But again, overall, the long-term trend and breadth picture are still positive, and that supports a positive technical picture. So overall, the market is healthy, right? Despite some froth in certain areas. So you want to take advantage of that, rotate towards more favorable technical valuation setups, take a little bit international risk, take some small cap risk in the marketplace. The fixed income, we saw the yield curve steepening at higher long end, supports the short-term growth story, but could be indicative concerns over long time frames. So to close, we want to remain balanced, tilting into tactical opportunities and really take advantage of that valuation dispersion we're seeing in certain different asset classes. So that's the presentation. And again, I thank you all for coming along this journey with me. So with that, I'll turn it over to Amanda to see if there's any questions out there.
Hi, Chris. Thanks so much for all of the information. It was really informative. I do have a couple questions, but just as a reminder to everyone on the webinar, there's a Q&A button at the bottom of your screen. You can submit any of your questions, and we'll try and get to as much as we can in the next 5 or 6 minutes before we end the webinar for the day. So the first one we have is, why is inflation so sticky?
Yeah, economic growth is just there. But it's interesting, right? Because, you're given 525 basis point rate rise, you would think inflation would be, more closer to target. I'm kind of looking at inflation, my view is kind of colored by what I grew up with and, what I've learned. And really follow Milton Friedman, right? The great economist in the Chicago Booth School of Business. And his really mandate was, and his quote that we probably all heard is, inflation is always and everywhere a monetary phenomenon. So what does that mean? I mean, the amount of money in the system is the main driver of inflation. The more money sloshing around the system, the higher the inflation. And we saw that with the government spending, right? The fiscal policy, there's a lot of money, despite the Fed trying to cramp down on the rising rates and tramp down on credit, it's being offset by the federal government. When we talk about the Fed kind of trying to tamp down that inflation, raising rates really a blunt tool, right? It's a big hammer. In theory, higher rates should reduce demand for credit, which slows down the economy, which reduces overall demand, less money sloshing around the system, pushing prices down. But that doesn't mention fiscal, right? Deficits increase money supply, therefore increasing prices, right? To really cure that, the Fed needs to really launch a nuclear strike, right? It's not 5% interest rates, it's 7, 8, 9% interest rates, or just accept higher prices, which is probably what they're going to do, which means higher for longer. And it's not always a bad thing, right? Inflation is not bad if you have growth above the inflation rate and your standard of living is rising. So in general, it's just there's too much money sloshing around the system. And until that money kind of gets pulled out, we don't think inflation kind of makes that last mile down to 2%.
Thanks, Chris. The next question we have is, given all the government spending, do you worry about a credit downgrade for the US? And at what level do you think would it happen?
Nothing having easy questions. Yes. So government spending, yes, definitely concerned. In terms of credit downgrades, so we have concerns about government financial situation in general, but in terms of credit risk, not really a big concern. Still a risk. We've seen this before, right? 2011, we had a temporary effect of some dislocation in the marketplace. And we saw the most recent downgrade in 2023, with most people probably don't know, since nothing happened. I mean, 2 out of 3 rating agencies, downgraded us from AAA to AA plus. Had really little to no impact on the marketplace or anything. So it's not a huge risk, but in terms of levels, what would drive the downgrade? Well, we're currently around 99%, debt to GDP, public debt to GDP. We're slightly above the 90% level that, Reinert and Rokoff use as the trigger for increased risk of default in the seminal work on sovereign debt crisis. This time is different. It's just a book that came out right after the 2008 crisis. They've studied debt downgrades on sovereign debt throughout history, going back to the 1800s. And they really use that 90% as, where people should stop being concerned. So the ratings cuts above did seem warranted. So the easy answer is they've already downgraded, so it's not the risk. But the next downgrade is in the hands of the rating agencies, right? Fitch, Moody's, S&P. And they're not telling what, or even hinting at what would trigger a downgrade. And they can't, right? Because they would affect the marketplace. It's interesting. I did recently read one research paper from the Penn Wharton School of Business. So again, it has impact on the Fed. And their paper kind of provided support that the US could support a 200% debt to GDP ratio before the next crisis downgrade. So to me, it's really anyone's guess, but more importantly, in my mind, I'd really watch the dollar, right? That's going to give you the clues as to when big investors, which means the credit rating agencies, are getting nervous. So we saw tremendous weakness in the dollar, really saw a huge sell-off. Foreign companies not buying our debt, that would give you clues as to when the next credit rating downgrade may happen. But we don't see that happening anytime in the near future right now.
Thanks, Chris. We do have 2 more, we've got a couple more questions, but
Sure.
one of them is, we have multiple on, is how do you foresee the election affecting investments? And what strategies would you recommend to navigate any political changes in the market?
Yep.
I think that gets the general consensus of everyone's question.
I know, as much as I try, I can't get away from the political questions, right? It really wouldn't be a Stonehearth Capital webinar without a political question somewhere in there. What are we now? 4 months? I think it's 4 months. 4 months away, and we have one candidate who's on trial, and another candidate is having issues proving to the general electorate that he's mentally capable to hold office. All I can say is, buckle up your seatbelts. It's going to get bumpy. Could be interesting. We'll see. But, in terms of portfolios, there really isn't much difference between the two parties in terms of enacted policy, since we have such a divided government, which we don't think the election is going to change, right? Most of the House seats are safe. Most of the Senate seats are safe. You're just going to end up with the president changing or not changing, but makeup of Congress kind of still staying the same. But the big takeaway for me from policy is that, with the current deficit situation, policy will be thrust upon the politicians, right? Not the other way around. Politicians are not going to dictate policy. The current fiscal condition of the US is going to dominate policy. And we've seen throughout history that once those interest payments, right, rise, and that's because more debt, higher interest, that the hand is forced. They have to raise taxes. They have to spend less. So it's really not an election outcome. It's really that fiscal standing of the US. We should get some increased vol around the election, as we always do. But as we've seen throughout history, it's usually temporary and past, no long-term effects. So really no changes needed at a portfolio level. But as always, we'll be looking at the weight of the evidence in totality. Again, looking at it from a valuation lens, a macro lens, a sentiment lens, a technical lens to make those portfolio allocation decisions.
And Chris, I think we'll just wrap up here with this last question now that it's about 1 o'clock. But if we didn't get to your question, Chris or I will reach out to you privately and make sure we get your question answered. So this last one here is, how worried should we be about the federal deficit? Should, for example, the CHIPS Act be offset by raising the corporate tax rate?
That's a political question and a personal view, and I have my own personal views on what that should be and what should be done. The biggest thing about my job is I need to look at the world as it is, not how I want it to be, and what's the most likely change. Given either president and a divided government, we don't really see an easy path to raising taxes. Doesn't mean it can't happen. And again, I'm telling you what we think's happen, not what I think should happen. So I really don't see that happening in terms of offsetting all the spending. At some point, it's going to be thrust upon them, just not anytime in the short term. So again, I know I'm being, a little cagey about answering your question, but in terms of what we expect, no, I don't think raising taxes are in the short term. Longer term, yes, definitely. At some point, government has to cover that deficit spending at some point, and make up that and keep that gap closed. They don't have to close it entirely, but they can't have it keep widening forever. It has to start coming down the other way. And taxes would be one way to cover that. And so again, I would expect higher taxes, just not anytime soon.
Chris, thank you so much for CIO's Corner and for all of this information. For everyone who's on the webinar, Chris does host these webinars quarterly. Our next webinar will be August 7th at 12 p.m. Eastern Time. It's already live. You can sign up for that right on our website, which is www.stonehearthcapital.com. And right on that main page, you can just scroll down to the bottom. There's a section for CIO's Corner. And we'll also go ahead and upload this webinar to our website. So if you'd like to go back and revisit a section or to rewatch it in its entirety, you'll be able to do that hopefully by the end of the day. But I wanted to thank everyone for joining us, and thank you, Chris.
Thank you, everyone. Hopefully better weather's around the corner. Talk to you next quarter.
Take good care.
Yeah, bye.
Bye.